There's only one surefire guaranteed way to get rich in stocks, but it's not exciting, it's not sexy, which is why most people don't follow it and they never become truly wealthy. But in this video, I'm going to break this all down for you. And if you follow this plan, you can build more wealth for you, your kids, your grandkids than you've ever imagined. So stay tuned. All right, welcome back. If you're new to the channel, my name is Mark Moss. Welcome. I like to talk about making money. I like to talk about investing money. I like to talk about having overall success. If you like any of those topics, please smash that like button right now. It helps the algorithm, more people to see the videos. And yeah, let's talk about it. I'm sure you like those topics. Last week, the last video, I talked about how to make money in this new kind of economy, this new market that we're seeing today. We're back to how do we invest that money. And you know, if you've been watching my channel, if you've been watching the videos, I always say that success leaves clues. And that's true in all areas of life. We find people that already have success, whether that be health, wealth, relationships, whatever. We find people that have success we want. We do about the same things they were doing, and we should have about the same results, the law of sowing and reaping. And so again, if you spend time on the channel, you know that I spend a lot of time breaking down successful people so we can learn from them. And today I am going to break down arguably the most successful investor of all time so we can learn how he's achieved that and more importantly, how we can model that so we can have about the same success. And as I said in the intro, this is the only surefire way to get rich in stocks. Now, if you don't make it to the very end, I'm just going to tell you right now, if you don't make it to the end, I am going to be doing a free 1 hour long training to teach this method to you, show you how you can leverage this surefire way to wealth. And so you can just check on the link in the description right now for full details. But don't leave now. Stay to the end. So let's jump right into it. I'm going to give you a little mini training right now. So when I talk about arguably one of the most successful investors in the world, I'm probably referencing Warren Buffett, and I reference him a lot because of his success, right? Because there's a lot of things that we can learn. Now, before you roll your eyes and turn the video off, I get it. Warren Buffett hasn't done that well in the last, decade, 15 years. He doesn't really get technology. He's an older investor, but many people have it wrong. The reason why he doesn't like Bitcoin or the reason that he doesn't like gold is for exactly the reason I'm going to teach you right now. Okay? The very reason you think Warren Buffett is a bad investor is because you don't understand his investing strategy. But I'm going to break it down for you. And if we follow this investing strategy, we can not become as rich as Warren Buffett, but we can have a lot of success. Now, we can do both. We can follow this investing strategy and make a lot of wealth for our kids and grandkids, and we can also invest into gold and Bitcoin, okay? We can do both. We should be doing both. As investors, we need to diversify. Okay, enough about that. So let's go ahead and jump into it. What can we learn from this? Now, obviously, he's one of the richest men in the world, most successful investors in the world. And most people think it's because he bought the right quote unquote right and quote unquote cheap stocks. So we bought the right stocks at the right time at the right price, right? And we can see that basically an entire generation of professional investors claim they are quote unquote value investors, just like Warren Buffett. So all these people trying to copy Warren Buffett saying they're value investors. But here's the thing. All these investors, these value investors copying Warren Buffett, they have it wrong. All right. It wasn't just value investing. All right. Now, Warren Buffett was a value investor up until about 1969, but then things changed. And that's why it's important to break this down. You see, like I said, Warren Buffett was a value investor. He followed in his mentor's footsteps. His mentor was Benjamin Graham. He wrote one of the most important investing books of all time. You should definitely read it. And so basically, he kind of explained what this being a value investor means. And basically, a value investor is buying stocks whose stock market capitalization is worth less than their net assets. So basically, if you took a company and you broke down all their assets, and let's say their assets equaled $100, but their market capitalization was $50, that means I could buy the company for less than the cost of their assets. That's a great deal, right? So he was buying companies for less than their worth. Of course, we like that. It's a great business model to follow. I mean, if you could buy $1 for a quarter, would you do that? Of course you would. And if you could do that, how many times would you want to do that? You'd want to do it over and over as many times as you possibly could, right? But what Buffett learned was buying stocks at these great values was only part of the equation to making a lot of money in stocks. What he found was equally or just as important was to invest in the right stock, to invest in safe stocks that can compound their earnings for decades. All right. Then if you can do that, then you have to do the hardest part, the hardest thing. And what's that? Never sell. All right. That's what he did. He never sold. So we can learn how he did this and we can model it, like I said, for our own investment portfolios. And so let me break this down. And I'm going to use one of Warren Buffett's most famous investments into beverage giant. I call it a world dominator. It's Coca-Cola. Coca-Cola is obviously a world dominator. They dominate the beverage market. And so when we break this down, we can look, Warren Buffett bought his shares in Coca-Cola between 1987 and 1989. Now, at that time, it was a huge investment for him. All right. Now, when I say it was a huge investment for him, typically we put a couple percent into a position. He'd put about 60% of his investment portfolio into Coca-Cola. Now, like I said, that's a much larger share than I would typically recommend. It's a much larger share than most people would put of their investment portfolio into a position. It's bigger than is normally recommended. So how could Buffett have known Coke would be such a good stock? How could he have known that Coke would be a safe stock? And then it wouldn't, and how could he know that it would actually turn into a great investment? To have so much conviction, he'd put so much in. And when we dig in and we do the research, we found that he came to this conclusion based off of how he broke down the company. So he looked at it through a certain lens, and I'm going to show you what that lens is. And so we can use that same breakdown, that same lens to find similar deals for our own portfolios. So this is what he found when he was analyzing Coke. He found out that Coke was a simple business, obviously, right? But that's important. He found it's a simple business. We don't want too complicated business. So Coke made soda. They made soda 100 years ago. It makes soda today, and probably in 100 years from now, it's still going to be making soda. All right. So that's the first thing. So that's a perfect setup for a business that can keep growing its sales and profits without having to grow its expenditures. All right. So it can grow sales and profits without having to grow its expenses. That's a big key. And judging by Coke's previous marketing results and its expansion into all the new markets, its sales would also continue to grow. As Buffett would tell you, it wasn't that hard to figure out. Okay, so you take a simple business that's been in this, the same business for a long time, will be in the same business for a long time, and it can continue to grow its sales and profits without having to invest into expenditures. Sounds pretty simple. I like it so far. Now, after Warren Buffett bought Coke, then other investors jumped in and bid the shares up to stupid levels. As a matter of fact, Coke was trading for more than 50 times earnings by 1998. So about a decade later, it was up to 50 times earnings. But the big key is here, like I said, the hardest part is that Buffett never sold. Now, it didn't matter to him how overvalued the shares became. All he cared about was that the company kept raising the dividend. Now, most people would sell. That's why I say it's the hardest part. It was up huge, but he didn't sell. All he was concerned about, the company's raising its dividend. Now, in 2019, Coke paid out $1.60 in dividends per share, if you adjust this for the stock splits and the dividends already paid out. But when Buffett purchased it, he only paid about $2 per share back in 1988. So that means that Coke's annual dividend 32 years later was now equal to 80% of his total purchase price. Amazing, right? So each year he's earning 80% of that investment. So if he paid $100, every year he's getting 80 cents back, 80% back of his investments. And that's whether the stock goes up or the stock goes down. It doesn't matter. That's what he's getting back just off his dividends alone. And we can learn more about how he looks at these types of businesses from reading his 1993 letter written to the Berkshire shareholders. These are famous letters. If you've never read any of them, you should. They're really, really good, very, very insightful. And basically in 1993, he wrote a letter to the shareholders, and he wrote about his reasoning for buying Coke. So he gave us a little bit more insight into what he was doing. And he wrote about his investment approach, and that is that buying stable, capital-efficient companies with the intention of holding them forever. So simple. That's why so few people can do it. Like I said, it wasn't sexy. It's not sexy. It's not exciting, but it's the surefire way to do that. So you buy them with the intention of holding them forever so the compounding returns would make a fortune. In the letter, he said, quote, We prefer instead to focus on the economic characteristics of businesses that we wish to own. Is it really so difficult to conclude that Coca-Cola and Gillette possess far less business risk over the long term than, say, any computer company or retailer worldwide? Coke sells about 44% of all soft drinks, and Gillette has more than 60% share in value of the blade market. Leaving aside chewing gum, in which Wrigley is dominant, I know of no other significant businesses in which the leading company has long enjoyed such global power. The might of their brand names, the attributes of their products, and the strength of their distribution systems give them an enormous competitive advantage, setting up a protective moat around their economic castles. End quote. So if I break this down for you, what he said, if I break it down, Buffett's looking for companies that produce high annual returns when measured against the company's asset base and require little additional capital. So he's looking for a kind of financial magic, if you can call it that. These are companies that can earn excessive returns, that can continue to produce returns, like I said, without requiring excess capital. So he's looking for companies that seem to grow richer every year without demanding continuing investment. So in short, the secret to Buffett's approach is buying companies that produce huge returns on tangible assets without large annual capital expenditures. He calls this attribute, quote unquote, economic goodwill. I call it, quote unquote, capital efficiency, or I call these types of businesses capital efficient businesses. Now, these kinds of returns shouldn't be possible in a rational free market. But fortunately for us, for you and I, people are not rational, right? They frequently pay stupid high retail prices for products and service that they love. And Buffett explained how another of his holdings, another capital efficient holding he has, See's Candies, earned such high rates of return on its capital in his 1983 annual letter. So if we go way back to 1983, we can see that he said, in explaining See's ability to consistently earn a high return on its assets, which was about 25% annually at that time without any leverage, Buffett wrote, quote, "It was a combination of intangible assets, particularly a pervasive, favorable reputation with consumers based upon countless pleasant experiences they have had with both product and personnel. Such a reputation creates a consumer franchise that allows the value of the product to the purchaser rather than its production cost to be the major determinant of selling price." So did you catch that? That's the whole magic. When a company can maintain its prices and profit margins because of the value that's been placed on it, placed on the product by the purchaser rather than the production cost. So that means that, like, if you looked at, a bag from Walmart, you go, well, that bag didn't cost more than $12, so I'll pay $20 for it. But when you look at a bag from Louis Vuitton, it probably didn't cost more than $100, but yet people pay $3,000 or $4,000 for it. And so they're paying way more for it because of the brand. That's what he's basically saying. So that way businesses can produce excess returns that aren't explainable by rational economics. Because like I said, people aren't rational. So those right there are exactly the kinds of companies that you want to own. Now, if it were that simple, we'd all be rich. So buying these kinds of stocks is actually, it's actually way more difficult mainly because you rarely get the opportunity to buy them at a reasonable price, let alone what I call a no-risk price. So that's why I urge you to make a list right now of these kinds of companies that you want to own that fit into this criteria. And then you can determine the prices at which you can buy them at, like I said, this no-risk basis. And then what you do, you have your list, you have the price you want to pay, and then you wait. Then you wait for your opportunity. You want to buy these companies whose products and services, the ones that you believe in, the ones that are loved, the ones that are most likely to be extremely long-lived, like Coca-Cola still selling Coke 100 years from now. And you want to try to acquire the assets that your children's children will never want to sell. You want to set your family's wealth on the path of compounding, just like that Coca-Cola story. And if you do that, then you can build wealth for your kids, build wealth for your grandkids. You can join other families that have passed it down to generations like the Rockefellers. But only if you never sell. Like I said, that's the hardest part. Only if you never sell. Everybody wants to be a trader today, and we've got this, we've lost this long time perspective. But the key is to buy the right company, the company you never want to sell, and then don't sell it. That's how you build the wealth. That's how you win in the long run. Now, the good news is this reset that we've seen in prices based off the economy being shut down because of the CV situation that we have has given us a chance to get into a lot of these positions at some really good prices. The types of opportunities that we don't see often, to buy these types of companies, these capital efficient businesses, the ones that I call world dominators, like Coca-Cola, how it dominates the markets. And so we're seeing these deals today. Now, I know the market looks like it's up, but a lot of these positions are still really, really down. And in addition, a lot of market analysts, including myself, still believe we have another crash coming. And so as good as the opportunity to buy some of these companies is right now today, which maybe you want to do that, we might have even a better opportunity, maybe the best opportunity we've ever seen to acquire these world dominators very soon. But you have to be ready. You need to have your list. You need to know what prices that you can pay. And so that way, when you hit those prices, you have your alert set up and you know to automatically buy them. So you need to have your list ready. Now, do you have a list ready? Do you know what I'm talking about? I hope so, because I have my list ready. Now, if you'd like to learn more about exactly how to find these companies, how to find the companies that I call, like I said, world dominators, exactly what criteria I'm looking for, how to track them, how to find out what this no risk price is to buy them, how they've historically held up against market crashes and rallies, then I'm inviting you to join me for a special free training that I'm going to do where I'm going to cover all this. All right. So I'm going to teach you all this so you'll know how to find these world dominator stocks to own. I'm going to show you how you can make your own list. I'm going to show you how to find the prices that you want to pay. And so that way you can be ready to pounce either now on some of these that are ready to buy, but also if the market dips some more, you'll know exactly what to buy when that happens. All right. Does that sound awesome? So check the link in the description, sign up for that free training and come. I can't cover it in a short YouTube video, obviously. That's why you got to sign up for it and come. And that's it. Give me a thumbs up on this video if you like it. Leave me a comment down below if you are looking for your own world dominators. Do you have your own list? If so, tell me what they are down below. And if you know what price you want to pay, you can tell me that too. All right, that's what I got for you today. Like I said, leave me a thumbs up. If you don't like the video, that's fine. Leave me a thumbs down. Either way, let me know in the comments because I'd love to hear from each one of you. And that's all I got. To your success, I'm out.